Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in a half hour's time. Let's get to the stories we are following in the BNN Bloomberg newsroom. The Prime Minister, Mark Carney, says GST credit payments will increase by 25% over the next 5 years, the bump up starting this year. Ottawa will also provide a one-time special payment equivalent to 50% of the GST credit. It is an effort to tackle affordability concerns.
We're working to address the root causes of inflation and working on longer-term solutions to bring down the cost of groceries in Canada. That starts by improving the resilience of our supply chains. Because when issues arise in supply chains, from transportation to process to distribution, costs rise at every step along the way, and these costs end up on the grocery bills. These payments make up for the higher level of food prices since the pandemic.
Shares of Allied Gold are trading higher after China's Zijin Gold agreed to buy the Canadian miner for $5.5 billion. Under the term, 3 African assets and development projects will be added to Zijin's portfolio. We spoke to Allied CEO, who says the deal is part of a broader process that will ultimately benefit shareholders.
I think the shareholders should be comforted that they're getting a very fair deal. And one more thing that I think is important here, which is that we're in a business of creating options and optionality. So in that context, and risk mitigation is part of that. In that context, I don't know where gold price will go. I'd love to believe what you've mentioned, that gold price continues to go higher, but equally it could go lower. And if it goes lower, shareholders have the certainty that they've got an underpinning in their share price with a cash deal of $44 per share.
China says a preliminary trade deal with Canada acknowledges a new type of strategic partnership, and it's not aimed at the U.S. Donald Trump threatened 100% tariffs on Canadian goods if the deal gets finalized. Beijing has agreed to ease tariffs on Canadian canola and allow visa-free travel for Canadians. Ottawa is allowing some Chinese EVs to get sold in Canada at a lower tariff rate. Here's where we stand on the markets right now. The TSX down 49 points today to 33,095. South of the border, the S&P 500 gaining 45 points. It's up 0.7%. The Dow Jones has a 369-point move up, 0.75%. And the Nasdaq, 138-point gain on the day, up 0.6%. As gold hits record levels again, investors are rotating into safer havens. We know that because the gold run up last year and this year continues. Let's go to Christopher Curlow. He's Senior Portfolio Manager and Investment Advisor with Canaccord Genuity. Thanks for coming in.
Thanks for having me.
What a run it's had, now over $5,000 an ounce. Do you think it'll carry on this year, this run?
Honestly, we've been pretty heavily invested in the precious metals trade for over a year and a half now. If anything, we're lightening up a little bit, looking for a pullback. You could see, gold at 5,000, silver over 110, I think today. They can give up some of those latest gains pretty quickly, at which point we'd be adding back to our positions.
Interesting. Okay, what about silver, which has also had an incredible run?
Yeah, critical metal. We're an owner of Microsoft. They're building a data center in Texas right now that's going to require about 5,000 tons of silver. They want to do about 15 of those. For the last 3-4 years, we've been running at 5,000 tons of silver deficits globally. And so you see this mismatch in supply and demand. And, we need it for everything, for the data centers, which are becoming not just creating cool images on ChatGPT, but also a critical component of technology, defense, and sovereignty.
Okay, you mentioned you'd wait for a pullback in gold before putting new money in. What kind of pullback would you look at?
I think we like the miners at this point. There's still a few. We own Agnico Eagle, Alamos, both key positions in the LWC portfolios. We'd probably just be adding back to those, which we've been trimming, programmatically here for the last probably 6 or 8 months. We've had to take profits 2 or 3 times on both those names.
There are some who think silver's going to correct and correct wildly, like it's really going to come off. Would you put some money in where it's at today? Would you also wait for a correction? If so, what would that look like?
Yeah, we've been adding to silver names. I was looking at a silver deal this morning, doing some site visits not long ago, and so I think that there's a lot of underappreciated assets out there. And it's not so much even the mines. You know, the challenge that we've been hearing with Donald Trump, it's also that smelting, that midstream refinery. I think that I'm excited to see where we can build some of that capacity here in both North, South America, where we can control a little bit of the flow of that silver to North America.
Okay, let's talk about the energy file, because I know you like a few names there. And I'm wondering if the names you like are based on sort of the AI build out or infrastructure built in Canada, or where they're coming to you from. Pembina is one of them.
Yeah, so Pembina is a recent addition for us, 6% dividend, fully supported by free cash flow, very low debt profile, more east-west piping. They have a modular system, tend to be close to the asset base. We funded that trade with some profits from TC Energy and Enbridge, which obviously have some huge north-south component to it. With what happened in Venezuela, we thought we'd diversify our geopolitical risk a little bit with that trade, but net overall adding to energy, which is one of the few sectors we saw value coming into 2026.
Okay, so you mentioned Enbridge along those lines. AltaGas is another you're looking at?
Yeah, again, it's just leaning into this energy theme. After our Canadian dividend portfolio being up 26% last year, pretty hard to find value out there, and low risk. It's more of a utility stock, but has energy beta to it. You can see the chart here; it's come off a little bit, so we thought we'd add at the start of the year, with the TSX up almost 4% already so far in January.
Okay, so we talked precious metals, we talked miners along the same lines, we talked energy. Where else are you looking to diversify?
We use liquid alternatives now. We're not huge fans on the bond trade. I think if we saw the 10-year yield creep back above 4.5 or you're closer to 5, we could be adding some diversification through bonds there. We've seen this rolling correlation between bonds and equities over the last 2 years, so you're not really getting it. So we own things that are merger arbitrage strategies or credit strategies that are just plain idiosyncratic credit events, not so much like long duration, like a traditional fixed income manager. And I think it's crucial to add that to things like the precious metals trade. We see that as a diversifier. Gold's obviously broken away from a beta standpoint, even a little bit of crypto, Bitcoin exposure across the board in our client portfolios.
Let me ask you if you're staying away from sectors that you think could be affected by tariffs. We have Donald Trump now threatening a new 100% tariff on Canadian imports. We know the language changes constantly, but CUSMA is up for renegotiation. So are you trying to stay away from sectors that could get hit by this?
As we've seen over the last year, it's been a lot of rhetoric. Canada and both Mexico have actually been the biggest winners in this trade war, with about a 5% tariff net over the last 12 months. Obviously, China's been on the other end of that spectrum, and then everyone else in between. So we've been, doing pretty well with it. Obviously, reliant trade partners, so we don't pay much attention to it. We were actually big buyers during April around Liberation Day. A lot of stuff came on sale, and so we have a short list of names that we're looking for. If we had weakness related to trade talk, we would make those adjustments. And I think the Pembina trade that you talked about is also a bit of that. Let's stay focused more on trade of oil inside our own country versus being reliant of getting our heavy crude down to the United States.
Okay, I'm going to leave it there. Christopher, thanks for coming in. Good to see you. Christopher Curlow, Senior Portfolio Manager, Investment Advisor at CG Wealth Management. Coming up next, Prime Minister Mark Carney stated Canada has no intention of pursuing a free trade deal with China after Donald Trump made those comments or threat to impose a 100% tariff. We're back in just a moment. If you had hopes all would be quiet on the trade front for a while, those hopes were quashed with the American president now threatening 100% duties on Canadian goods. Let's go to Lawrence Herman on this, international trade lawyer and senior fellow at the C.D. Howe Institute. Thanks for joining us today.
My pleasure.
Do you think Mark Carney's speech in Davos is what has changed Donald Trump's tune? He had already pulled back on CUSMA negotiations, of course, because of that Ontario ad as well. Does Ottawa need to do some reach out here?
I don't think what the Prime Minister said at Davos was the reason why Trump has threatened 100% tariffs. I think we're dealing with someone who is undisciplined and erratic and would use any excuse to threaten Canada, as he has done recently. I don't think it was the Davos speech itself that stimulated this latest eruption by Mr. Trump. All of this shows, Morella, that the next while is going to be uncertain, unstable, and there will be serious elements of risk involved in the Canada-U.S. trading relationship. There's no question about that, in my view.
What is your take on the trade agreement between Beijing and Ottawa? Do you have any concerns about it?
Between China and Ottawa?
Yes.
I don't have any concerns about it. We're talking about 49,000 vehicles in a multi-million dollar, almost multi-million dollar Canadian market. And these EVs will not have, I don't think, a major impact. At the end of the day, it'll be the Canadian consumer that will have to determine whether those products should be purchased. And so the market will have an impact. It's not just the volume of EVs at a low duty rate, it's whether the Canadian consumer wants to buy these EVs, and that'll depend upon dealerships and the efficiency of aftermarket service. So there's a lot of factors that enter the picture, and it's not just 49,000 EVs that I think will be disruptive. And indeed, if they are, I might add, we have ordinary trade laws that can be used to remedy any injury that these EVs might cause if they're unfairly traded, i.e. subsidized.
Okay, so as you know, the Americans have raised concern about Chinese goods being dumped in Canada to cross the border into the U.S. One of their concerns, of course, would be about cars because they have a 100% markup, of course, on Chinese EVs. Are their concerns legitimate?
It's hard to imagine, given the size of the American auto market, that 49,000 EVs, even if a good portion of them somehow transited to the U.S. market, would have any impact whatsoever. No, I think what we've seen is Mr. Trump using his aggressive tactics, his enormous size and power to threaten Canada for reasons that really are untenable. But what this illustrates is the factors that will come to play when we're trying to review, renegotiate the USMCA. It will not be an orderly process. I think we're going to be faced with some very stiff demands from the U.S. side, i.e. take it or leave it, and we'll have to deal with that. Mr. Carney has shown that Canada has other options. They're not complete options. In other words, the U.S. market will always be important to us, but they are options, and Canada has an independent trade policy and should use those options. I say full speed ahead for Mr. Carney.
That being said, could we face the same pushback on every deal sought to diversify trade?
Well, that's right. And as I said, we have to face the fact that the next months, indeed, the next years, as long as Mr. Trump is in office, will be very uncertain and unstable. I don't see how Canada could ever convince the United States to abandon its so-called national security options. In other words, Mr. Trump, as long as he is in office, is going to insist on the right to raise or lower tariffs depending upon what he sees as U.S. national security interests. It's going to be very difficult to discipline the Oval Office in this regard. This is a new world that we're involved in. The trading rules have been destabilized completely. It might be out the window. And so we're going to have to deal with these realities. I think Mr. Carney went very far in addressing these realities in Davos, to his credit.
With the Buy Canada movement and Canadians avoiding trips to the U.S., do you think that Washington is feeling any of this? Again, it's like the mouse, with the elephant. we're the mouse. But do you think that there's any pressure on Washington as a result of the move away from U.S. movement?
I think there is. It is, in a way, isolated in various constituencies. It's not across the board, but there are those areas of the U.S. economy, the U.S. industries that are impacted, seriously impacted by his tariff wars against Canada. And those various interests may have an impact on the whole review process of the U.S. MCA. Canada and Canadian business have done a very good job of raising these points in the U.S. with their direct contacts. That is a very good strategy that we've been following. The embassy has been very active in this regard. And so hopefully those pressures, making it clear that the U.S. has a lot at stake itself in this trade war with Canada, will moderate the worst impulses of the president and his entourage.
Lawrence Herman, good to have you, sir. Thanks for joining us on the program today.
My pleasure.
Coming up next, Zijin Gold signed a deal to buy Allied Gold. It's a $5.5 billion deal. Our conversation with the CEO of Allied Gold when we come back. As the price of gold continues to set record highs, we're starting to see merger and acquisition activity in the sector. Toronto-based Allied Gold has signed a friendly deal to be acquired by Chinese miner Zijin Gold for $5.5 billion in cash. We were joined by Peter Moroney on this, chairman and CEO of Allied Gold.
This is part of a broader process. We looked at the landscape from the point of view of what assets are there to purchase that would be synergistic. What can we afford to pay given our balance sheet? What's in front of us in terms of the obligations vis-a-vis that balance sheet? Are there business combinations that we could pursue? In the end, we also looked at it from the point of view of if there's a buyer, who is a logical buyer or logical buyers, and what should they be paying? I don't believe that anyone would price something on the basis of the gold price today or on the basis of where the gold price should be expected to go. Normally, as you're aware in the market, people are pricing things based on some discount to gold price. So if I look at it from that point of view, with a discount to gold price that is above where gold price is in analyst models and in market more generally, we're getting very fair value for our shares. And adding to that is we're at an all-time high. We are at the high for the year in the last 12 months, and we're being paid a premium on top of that high, and a premium that is close to 30% to the 30-day volume-weighted average price of the stock. I think the shareholders should be comforted that they're getting a very fair deal. And one more thing that I think is important here, which is that we're in a business of creating options and optionality. So in that context, and risk mitigation is part of that. In that context, I don't know where gold price will go. I'd love to believe what you've mentioned, that gold price continues to go higher, but equally it could go lower. And if it goes lower, shareholders have the certainty that they've got an underpinning in our share price with a cash deal of $44 per share.
Now, we've heard from some shareholders that feel that this could have been done differently, maybe re-rate on its own, and they're not excited with this deal. Are any worries about the vote that's coming up?
Well, every shareholder that is invested in our stock bought shares at a price that is lower than this, and every deal that we've done is at a deep discount to where this price is at. If I looked at it from the perspective of most of our larger shareholders, and certainly the shareholders that participated in the preceding financings that gave our balance sheet the robustness to build out our growth and get that re-rating, they would be making a multiple of their investment, certainly a premium to their investment, if not a multiple. So from that point of view, I'm not concerned about the carry on that vote at all. I would say to those investors that are saying, well, a re-rate is coming, so why not wait? I would say to them, why didn't you invest earlier? Don't wait for the re-rate, and you would have made a bundle of money in the deal that we're proposing.
Has anybody from outside the company looked at the deal and reviewed it?
Yeah, so we had a financial advisor. We formed a special committee. That's very typical, but I think it's important for governance. And that special committee had its own advisor that provided a fairness opinion, as we disclosed this morning. And so there is a fairness opinion. And fundamentally, the value is there at this price. The company is fairly valued. Can we argue that there's a range? The answer is yes, but we're well within that range. And we also have to look at it from the point of view, as I said a few moments ago, Roger, of what's the gold price that you assume. And if we look at the analyst models, what's on in market, how people are investing in our stocks, they're not taking into account $5,000 gold. They're not taking into account $4,000 gold long term. It's closer to $3,000. And I would argue that in what we're being offered in cash, all cash, is well above what is in those models and the use of gold price.
Now, this comes just after, not long after the announcement of deals and potential deals between China and Canada, but also we're in the middle of the trade war with the U.S. Any worries about the optics of this and then the fact that another company is coming off the TSX?
Well, let me deal with the first point first. I don't know that we've got the competency to deal with the geopolitical aspects. This is a company that has acquired assets before. It's a company that has acquired Canadian assets. Gold, as much as I admire the metal, is not considered a strategic metal. So I'm not concerned on the geopolitics. And on the TSX side, in the same way as when we sold Yamana in 2023, we formed Allied and listed it on the Toronto Stock Exchange. I will express a wish, which is that let's work on completing this deal. But once this deal is completed, are there other deals that can be done with this fit-for-purpose management that has done it with Yamana, has done it with Allied Gold, and are there other opportunities?
What's next then? What can you allude to what you might be looking at next?
At this point, I'm focused on going to our shareholders, communicating the message about what this deal is about and why our board saw fit to accept this deal and getting the deal completed. Let's come back to this in a few months and see if there's something else.
Okay, and if the deal by chance doesn't go through, what would be Plan B for you?
We continue with that robust growth that we have, as you described. What was it compelling to the multiple parties that looked at us and this winning bid? What was compelling to this bidder and others is that we are a mid-tier company that is underpinned by 2 Tier 1 assets. They are paying a robust price to get that, a fair price, however, to get that. So in that context, my view is that we continue with business as usual, and we looked at the other strategic opportunities to create value for shareholders that were always being contemplated and weighed one against the other by our board of directors.
Peter Marrone is chairman and CEO of Allied Gold Corporation. A last look at the markets ahead of the end of the trading day. The TSX Composite falling 62 points today to 33,082. The S&P is up 34 points. The Nasdaq has a 98 point move up right now, 0.4%. The closing numbers are up next. Stay tuned for that. Here are the closing bells for the end of the trading day. At the Nasdaq today, Maze Therapeutics ringing the closing bell. In New York, it's Hecla Mining ringing the bell. You're watching the close on BNN Bloomberg. I'm Morello Fernandez. Here's how we ended the day on Bay Street and Wall Street. So the TSX coming off its record high of last week, dropping 51 points on the day to 33,093. The S&P 500 has a 34-point gain. It's up about 0.5%. And the Nasdaq gets a 100-point move up today, 0.4%, taking it to 23,601. Let's have a look at the movers, and mostly miners on the move up today in Toronto. NovaGold Resources has moved up 5.5%. That's a gain of 75 cents a share today. I take a look at the 1 year. It's 232% up over the year. Eldorado Gold also moving today 4.5%, or a gain of $2.82. It got upgraded at Scotiabank. And then Skeena Resources also moving today 2.4%, or $1.03 up per share. Also upgraded today by Scotiabank. In the flip side, and in the red is Bombardier. It dropped over 9% today. That's a loss of $24.81, taking the share price to $240.88. Goldman cut to sell for Bombardier, and the Challenger jet crashed during the takeoff in Maine, so that's affecting the stock price today. Energy Fuels also dropping today 8.5%. taking the share price to $31.93. But over the 1 year period, almost a 290% gain. A quick look south of the border today. CoreWeave up on a deal with NVIDIA. NVIDIA spending billions of dollars to take more share investment there. It's up 6.2%. And then let's move up to another stock to watch, which is USA Rare Earth. It gained 7.6%, taking it to $26.65 after the U.S. government decided to take a 10% stake in the company. Let's go to Bloomberg's equities reporter Stephanie Hughes for more on the movers in Toronto. Stephanie, Canadian miners gaining a lot more on precious metals again today. Where do you want to start?
I want to start with, hello, Marella. I want to start with First Majestic Silver, which earlier in the trading day had been one of the best performers because of rising gold prices. Those shares gained by nearly 10% at their highest point, which sent the stock price to a new all-time high. And while it's still at a high, it did give up a lot of those gains as the trading day went on. Not entirely sure what happened there with the sell-off, but still in the green, still hitting record highs. And it's rising in tandem with precious metals prices, which all hit all-time high, new record highs, since the global trade upheaval is continuing to send traders to safer haven assets like your metals, like sovereign bonds, like currencies in this uncertain environment. So President Donald Trump is really just reshaping a lot of international trade partnerships with other countries, which is making it a lot more difficult for traders to plot the trading environment in the year ahead, especially when it comes to different sectors and industries and how these are all going to react. So that's sending gold prices to record highs of over $5,000 an ounce, and that's and we've been seeing that rally continue from the previous year, where it was a combination of uncertainty and lower interest rates. It's also sending silver prices to all-time highs, which is benefiting or had benefited more so earlier in the day, First Majestic Silver. And there's other, obviously, precious metals names like Nova Gold, you mentioned, Eldorado Gold, Skeena Resources. So to your point, it's been a mining kind of a day, Marella.
All right. So what more are you hearing from portfolio managers about the run?
Yeah, that's right. So I was curious to get portfolio managers' perspectives, and I had a handful of them get back to me over email. But basically, the tone has been the same, where they're looking at Donald Trump's comments about Canada over the weekend, namely the threat of putting a 100% tariff if Canada decides to really tilt into a full trade agreement with China. They're seeing those comments as more bark than bite at this point. Saying that they're not, they don't think it's likely for these 100% tariffs to actually go through. So they're not really reacting. They're not seeing the market react as much, except for in the commodity space, and they're certainly not making any trades off of it. Now, that said, one portfolio manager I spoke to or had a email exchange with said that if these did go ahead, which I should add, he doesn't believe that this will go ahead. If Canada does see 100% tariffs, then the economy would go straight through a recession and into a depression, which is alarming. But again, this isn't their base case scenario. They're thinking that Trump is just firing a warning shot to Canada to not get too close trade-wise with China.
Yeah,
Marella.
Trump being Trump. All right, Bloomberg, Stephanie Hughes, thanks for that.
Thank you.
Coming up next, again, North American stocks pretty much in the green today. The TSX, though, moving lower. Technology stocks gaining in the U.S. We'll dig into that in a moment. American markets rose today in anticipation of a week of earnings reports from some major technology companies. My next guest says there are questions about whether 2026 will bring meaningful returns on AI investments. Let's go to Steve Rolls, Senior Portfolio Manager at Trivest Wealth Counsel. Thanks for joining us today.
Hey, great to be here. Thanks so much.
We know investors have a lot of concerns about how many billions of dollars tech companies are investing into this build out. Have some of those concerns lessened? They started sort of late last year.
They haven't yet, but I suspect that they will. What we saw stemming from about September or so, we saw some concerns starting with Oracle, and it fed into the rest of the market. Are the AI spending, is it too much? So while we got big earnings this week by Microsoft, Meta, and Apple, I think the key is going to be how much are they spending on CapEx, not just the earnings, but how much are they spending on CapEx? And that's played into the market. We're seeing that Microsoft is down substantially about over the past 6 months, about 10% actually. So that's not quite the Mag 7 environment that we're used to. So what's the catalyst for that? Well, it's this AI cap spending. Looking at the AI development over the past few months, it's really evolved rapidly. And the hyperscalers are keen to invest more to capitalize on that and get that return of investment over the next few years here.
Okay. With earnings coming down this week and later next month, will guidance be more of a watch than usually it is?
Yeah, 100%. I'd agree with that, that it's all about the guidance. Getting back to Microsoft, they expect guidance for Azure to really be about 37% growth. So it's all about the guidance. Meta is another one that is really talking about their guidance as well on their ad revenue, and Apple further with services guidance and whatnot to really high guidance from the last quarter. So we'll have to see if that is maintained. But it's guidance and CapEx are the key themes over the next few weeks here.
Let's talk a little bit about the latest Donald Trump threat of a 100% tariff on Canadian goods. CUSMA, as you know, still up in the air. What are the implications for the market with this threat hanging over it?
I mean, it's been a threat for over a year almost. So it's really, is this a threat or is this a stalemate? And I'm looking at it as a stalemate. The market's really discounted it. I thought the markets would react a little bit today, specifically on the bond market. The international bond market is not making any decisions on the Canadian market yet. It's being deflected as this will happen, this will occur, that by June we'll get a deal, but it's coming. And we haven't got a deal yet. The deal with China was obviously miscommunicated to the Americans. I think Scott Bissett brought that up on the news in the US last week, that Canada will not be a base for cheap Chinese goods to enter the US. I think the parallel would be a market like the Hong Kong was the entry point into the free markets for China back in the old days and back into China in the new days. So that's on the table. So there's a lot going on here that needs to be addressed. And I think that comes down to, can Prime Minister Carney compromise a deal and get a deal done before we have the reviews in June?
Okay, let's get to a few of the stocks you like, and tech is the focus for you. You mentioned Microsoft being off 10%, so are you picking it up now?
Yeah, I think it's a great time to buy. I think I prefer to buy stocks that are, that downside protection has already been there. So it's off from its highs from a few months ago because of the AI news. But today, on the good news for Microsoft, they launched their new, it's called the Maya 200 chip. It just announced earlier today that that's going to be their new chip. The comparable would be the Google's TPU chip. So they are in the AI inference space now, and that is a big play. I'm surprised they issued this today and not during the earnings call, but I think it's a move in the right direction. I think Microsoft is flying on all cylinders here, and that, yes, they're spending a lot of money on the AI infrastructure, but they're making a lot of money, and they have $100 billion in cash, and they're deploying that cash, still being conservative with their debt. So I think it's a good time to buy Microsoft right now when it's down.
Okay, let's get to another stock you like, which is TELUS. And I'm wondering why you like TELUS among the other telecoms.
I like TELUS because I like the cash flow and I like the management and I like what they're doing. I like the fact that they're divesting some of their non-core assets to clean up their balance sheet. The stock is, as you can see by the chart, it's just above 19 today. It was at about 17 when I started to implement it into my portfolios. But more importantly, it has a 9% dividend. And the dividend was really the biggest concern a few months ago when the stock started to decline. I think it was a JP Morgan downgrade on the dividend. But looking at the dividend and the growth that was implemented continuously for TELUS, well, that's been on pause. And I think that's a prudent move. I think the market's trying to realize that. So if you're getting a 9% dividend with some upside, get it back up to 22, you're looking at close to a 30% move there when a total return. And for a retirement portfolio, I think it's just a top stock for the cash flow, the new balance sheet. So it's a highly recommended stock for retirement portfolios.
Just on the dividend, what they had announced was that they're not going to increase the dividend, but the dividend itself is safe.
Yeah, they still have positive cash flow, and so it was a pause. It wasn't a cut, and I don't see them cutting. I think that they're divesting. That's going to further increase cash flow. I expect that cash flow to increase over 2.5 billion. So it's a good safe dividend.
All right, Steve Rolls, I'm going to leave it there. Thank you very much for joining us. Steve is Senior Portfolio Manager, Trivest Wealth Counsel. Coming up next, is Canada fit in today's global AI industry? And what innovations can help improve productivity in our AI infrastructure? We're back in a moment. Tech companies creating the building blocks for AI infrastructure have been the focus of investors. However, attention is beginning to shift to companies who are able to use AI in their operations. On this, we were joined by Kevin Kang, head of global economic research at Vanguard.
There's one phrase that summarizes it all. It's called Vanguard effect, which basically is whenever Vanguard moves into a space, because that's what we care about, which is, the ultimate investor's investment outcome and success, that has a way of having a lot of positive externality for the end investors. Going back to your original question, so we've been saying this for a while. AI, we kind of view it as really one of those epochal technological advancements that we don't get to see. Really not every generation gets to see and experience. But when we first saw AI and its capability, our view has always been that it can have that really era-defining potential to boost productivity, but also really transform the way the economy works and is made up, as well as the way companies go about generating profits and doing their businesses. So the way we think of it is that this is going to come in phases, and our baseline view is that it's really on track to bring that transformative boost to productivity, both in U.S. and Canada, as well as many other economies. But the phase that we seem to be in for now is something that is reminiscent of many other technological cycles in the past, such as electricity, such as mass manufacturing after World War II, where there's an intense deepening of physical investment that happens just across the economy. So it's somewhat ironic, but AI is your ultimate cognitive power tool that we can all relate to having used it. And yet it actually calls for a significant historic capital investment build out. And then that is generating a lot of excess demand for, the old economy sectors, such as industrials, materials, and energy. And that has certainly showed up in stock markets like Canada's. It seems like it's continuing to show up both in the States and Canada.
You are a financial economist by trade. You've done a lot of research in active portfolio construction, household finance. Have you had much time to look into AI itself? Or even if you haven't, what has surprised you about this surge of excitement over AI as an economist?
So I think this just maybe goes back to what I mentioned about AI, that it being a once-in-a-generation thing, and its impact is going to be multifaceted, and it won't be necessarily everything happening all at the same time, all at once. It won't be necessarily that, but it's going to have multiple really innings and phases to it, the way in which it diffuses. The way we think of it is that it tends to create some sort of a binary reactions from just about everybody involved. Some people kind of look at its labor market implications and wonder, oh, is that going to be dystopian? Are human beings going to have jobs? And that's a very particular dark way of looking at that. And then the other on the other end of the spectrum, there are views that kind of suggest that, well, it's all going to be just nirvana, where all of us will be very productive and all of us will be able to reap the benefits of it. Our view is a little more measured, and it's maybe unsurprisingly somewhere in between, that it does have a lot of potential. If you look at people's jobs, any jobs really, and then look at all the tasks that people have to perform for their job, there are things that AI's capability is going to be a huge boon to productivity, just because you can automate certain things away and then you can help human workers do it better. At the same time, there are so many judgment-related tasks that just are simply still beyond the scope of what today's AI capability is able to replace. And that combined with how human labor, the complexion of human labor has evolved every time we had this type of an epochal technological advancement, gives us the idea that this time is in a way not going to be different, in that it'll be very disruptive. And certainly there will be pockets and segments that will be more disrupted than others. But at the same time, on the whole, its productivity impact is hopefully and likely will outweigh some of the downside implications.
Just to close up, I know that you and your colleagues have done work on AI productivity in the U.S. economy. If you could just switch your lens to Canada there, you did warn about U.S. demographic pressures. I think by that you guys mean an aging workforce.
Correct.
And you say generally you're looking ahead to a surge in worker productivity. There is a risk that AI fails to meet expectations. Is there a prospect AI will help our lamentable productivity growth performance in Canada?
And the short answer is yes. And here I want to maybe make 2 points. The demographic, the aging, and as a result, the labor force not really growing, short of a dramatic departure in immigration policy. That's more of a longer-term trend that we all have to accept and then get comfortable with. So that's a fact. The economy, any given economy that is aging, is unlikely to get a huge support from that channel. That said, I want to make this point that if you look at the Canadian economy, it still derives the vast majority of its income from anything that's related to services. So the services sector, despite all the headlines that we hear, and then even just the TSX composition of emphasis, and its emphasis on the physical goods related economy, the actual income is generated for the most part from services, very, very labor-intense activities. And what that means is that the field is really ripe for AI to come in and then really help generate and unlock productivity enhancement. And that actually is coming at a good time if you think about the longer-term demographic trend, because before too long, and perhaps Canada has been experiencing some of this, we would be looking for more workers, and we won't be able to find the suitable workers absent this AI-based technological and productivity boost. So in a way, it will be a very, very productive and very helpful tailwind. That's our view. And it's not a definitive thing. There's a lot that needs to be unlocked and then it needs to go well. But that's where, over 4,000 startups are, working day and night across the globe, but mostly in the U.S., to really unlock the productivity potential of AI.
Kevin Kang, head of global economic research at Vanguard. Coming up next, shares of CoreWeave higher today after NVIDIA announced an additional $2 billion investment in the AI infrastructure provider. More in a moment. Here are the stories making headlines today. The Prime Minister, Mark Carney, says Ottawa will launch the Canada Groceries and Essentials Benefit. Starting this year, GST payments will increase by 25% over the next 5 years, and Ottawa will provide a one-time payment in June, equivalent to 50% of the GST credit. This is all in an effort to tackle affordability and make up for the higher level of food prices since the pandemic. Allied Gold shares getting a boost today after China's Zijin Gold agreed to buy the Canadian miner for $5.5 billion. The deal will add 3 African assets to Zijin's portfolio and comes as bullion prices surge past $5,000 US an ounce. OPEC Plus likely to maintain its oil production pause for March. According to Bloomberg, the oil cartel will review its decision to freeze output levels during the first quarter, but is expected to leave the policy unchanged. The report says a significant supply disruption from events in Venezuela and Iran could prompt the organization to bolster output. China says a preliminary trade deal with Canada acknowledges a new type of strategic partnership and is not aimed at the U.S. Washington, Trump, now threatening 100% tariffs on Canadian goods if the deal gets finalized. The agreement would ease Chinese tariffs on Canadian canola and allow visa-free travel for Canadians. Ottawa is seeking to diversify trade because of American tariffs. Shares of CoreWeave popped today after NVIDIA announced it's investing $2 billion U.S. in the company. CoreWeave stock has been volatile more recently. Investors concerned about too much debt as it works to build out data centers. Let's go to Jay Goldberg, senior analyst at Seaport Research Partners. Jay, thanks for joining us today.
Thank you.
NVIDIA was already a shareholder in CoreWeave. Could you clarify the relationship? Because there are concerns, of course, about the circular financing.
So that's a complicated question. NVIDIA is an investor in CoreWeave. They are also CoreWeave's main supplier of GPUs. I think it's their only supplier of GPUs. They're also a customer. And now they're a partner and they're investing more. So it's pretty much all the things NVIDIA and CoreWeave are doing together.
Okay, so Jensen Huang, of course, says it's not a circular deal. Would you argue that point?
Well, I think it is at least a little bit circular. NVIDIA is going to give money to CoreWeave. CoreWeave is going to use that money to buy NVIDIA GPUs. In order to do that, CoreWeave is going to have to borrow a bunch of money in order to buy those GPUs because $2 billion isn't enough. So they're going to have to borrow money, and NVIDIA will be a guarantor of that loan to some degree. So it's a little bit circular. It's a little bit complicated. But this is NVIDIA's way of sort of seeding the ecosystem of what we call neoclouds, sort of alternative cloud service providers. And it's complicated. There is some degree of circularity there, but there's also a lot of demand.
Okay. Can you clarify or explain a little bit more about why there are concerns about circular financing? Because it is in context to the fact that people worry about the AI bubble. So if you could just explain the concerns around that.
So I think the question boils down to, is NVIDIA just providing sort of easy financing terms, like sort of facilitating the deal, or is NVIDIA actually creating that demand? And I don't think the answer is entirely clear. It's a little bit of both, right? If NVIDIA weren't investing in CoreWeave and weren't backstopping its loans and backstopping many of the other neoclouds, it would be harder for the neoclouds to do business. But they all claim that there's sort of insatiable demand. There's lots of demand everywhere. Again, I think it's a little bit of both here, where NVIDIA is sort of pushing demand along, but they're also enabling a lot of this in sort of fairly straightforward ways.
Okay, let's talk about CoreWeave itself. What is its bigger plan?
So CoreWeave is interesting. There are about 200 neoclouds out there. The number keeps growing, and that's obviously too many. I think most people looking at the space would agree that we're going to have some consolidation probably next year, where sort of the market rationalizes. And so the question then is, like, who will survive? Who can differentiate? Because to a large degree, providing cloud service on NVIDIA GPUs doesn't seem to be a lot of value for that neocloud as the intermediary. Everybody can buy NVIDIA GPUs. How are any individual company going to differentiate? And I think CoreWeave is the one very clear example that they have something a little bit different. They are better at managing GPU networks, arguably better than even NVIDIA using its own stuff. They have a lot of software tools. And one of the things that the company really pointed out today was that this deal includes a sales channel for CoreWeave software to other NVIDIA customers. And so CoreWeave, I think, is trying to differentiate itself to sort of show how it stands out from other neoclouds by having this sort of software element in their mix.
Okay, so CoreWeave, we know, has been trying to diversify its customer base. You're saying its avenue will be better under this new NVIDIA agreement, but has it been successful on its own to do that?
There are some signs that it's pushing forward, that it's sort of diversifying its customer base. It's still very reliant on Microsoft, OpenAI, and sort of two or three of the big hyperscalers. And we've seen some improvement, but they're still sort of 60, 70% reliant on three customers.
Okay. You have a hold on CoreWeave. I'm wondering whether the announcement today changes your outlook for the company.
Yeah, valuing all these companies is very difficult because right now the numbers are sort of they're getting a big benefit from numbers from these very large contracts from these customers, and we've seen this at a few other neoclouds too, like Nebius too, where they get these big contracts, and it's sort of like a snake eating a pig, like a boa constrictor eating a pig. There's this huge surge in a bulge in revenues, and how that sort of plays out over time isn't entirely clear. How to what degree can CoreWeave build a sustainable business, diversifying away from these big bulgy customers? And I think this is a step in the right direction. Like I said, I think CoreWeave is one of the best of the neoclouds out there, and this sort of demonstrates that. But it's really tough to value the equity right now. It's a pretty confusing, fast-moving landscape.
Yeah, or does it suffer some serious indigestion as it digests? Okay, Jay Goldberg, thank you for joining us. Appreciate it. Jay's a senior analyst at Seaport Research Partners. Coming up next, we'll look at 5 potential black swan events for 2026 that could impact global financial markets. Back in a moment. BCA has published a report outlining its top 5 black swan risks for this year. Let's go to Matt Grotkin on it. He is the chief geopolitical and U.S. political strategist at BCA Research. Thanks for joining us today.
Hey, thanks for having me, Marella.
Would you say the events are sort of possible but not probable?
Yeah, that's the right way to frame this. In this case, we actually deviated from the past. Every year we publish 5 black swans, and we tend to focus on things that are not receiving a lot of media attention. But this year, there's several prominent risks that are, larger than what you normally think of as a black swan, which is a small tail risk, maybe single-digit % chance of happening. This year, like the Iran issue is really blowing up. The potential for an oil shock is significant. And also, there's a significant risk of a major military incident, either between Europe and Russia or China and Taiwan.
Okay, so let's start with the collapse of an Iranian government. Walk me through the fallout of that.
Well, the main thing with Iran is that while there are large-scale protests, they're not necessarily bigger than the social unrest that's happened over the past decade. But it combines with a political crisis looming over the transition away from the current leadership with Supreme Leader Ali Khamenei at 86 years old. That can turn into a succession crisis, which means that there's a lot at stake here. And the Americans and Israelis are willing to intervene. In fact, we've seen that the U.S. already has intervened. And so in that context, if the U.S. does intervene more significantly, then the regime could be at risk of falling. The U.S. doesn't really want to do that, and Iran doesn't want to get bombed. So it's a tail risk. But unfortunately, because of the weakness of the regime, that tail risk is pretty large.
Okay, let's get to the next possibility, which is a tech breakthrough by China, a.k.a. like the DeepSeek moment. And I want you to give me an idea of why you listed this. We've already had the moment, but you're seeing the possibility of another.
Yeah, well, for one, because DeepSeek itself ended up being not quite what it was painted to be. And in many cases, China's technological advances have come with a sort of reservation about their ability to drive innovation without using American parts and components or American allied parts and components. So even though they're making progress and they are using a lot of state resources to do that, it's still difficult for them to make an innovation that fundamentally disrupts what the world expects in terms of American leadership. Nevertheless, that could happen because what we've had is over 10 years of state-driven industrial policy. And so those results can pop up at any time. And if they're really powerful, for example, if they're used in an open source way, or if they affect manufacturing applications in a really significant way, they disrupt entire industries like we've seen with electric vehicles. And if that happens in the AI space, it would be really momentous.
Okay, I do want to get to the next one, Russia and NATO being at odds. And I'm wondering how plausible this one is, because we know Russia has been so depleted by its conflict with Ukraine.
Well, the main issue there is that the United States is attempting to orchestrate this ceasefire, which does make strategic logic. And it does make sense for Russia as well to cut their enormous losses in blood and treasure. But of course, it is harmful to the Ukrainians because it requires everyone to sort of accept the current status quo on the ground, which means that Ukraine loses territory and will still be subject in future to Russian insults and interference. And meanwhile, the Europeans are concerned that there will not be a bulwark to prevent future Russian aggression. And so the issue is that the Russians can keep sort of provoking the Europeans to cajole them into a ceasefire. The Americans may not rise to Europe's defense very quickly. Europe will have to stick up for itself, and that creates the potential for a clash between Europe and Russia that could be pretty surprising. It may not lead to a full-scale war. I don't think it would, but it certainly could shake up the sense of security in Europe, and it could, in the worst-case scenario, lead to extended hostilities.
Do you factor in at all the possibility of the U.S. leaving NATO? You mentioned sort of it delaying the defense of Europe. Would you consider it leaving NATO altogether?
I mean, again, that would be a very low tail risk. Obviously, there's a lot of discussion about it. And I do think that if President Trump had been willing to use force to seize Greenland, that would have shattered the faith in the alliance. But of course, he then quickly renounced that, and that's what I would have expected to happen. He says we won't use force, and the reason is because he needs to preserve that alliance. That's in the U.S. interest. It's also illegal to leave NATO, so the Supreme Court and the Senate would fight the president on that issue, and the armed forces would not want to see their own influence. I mean, imagine the top brass in the United States losing the influence of having this gigantic alliance. Suddenly that alliance is broken up. They no longer have as much sway. So none of the institutional actors in the U.S. want that to happen. But what could happen would be the president, as the commander-in-chief, could delay and hesitate and shuffle around and effectively kill some of the spirit and some of the moral suasion behind the alliance. And that could cause irreparable harm, even if the alliance were pieced back together in the aftermath of the administration.
Very quickly, how should investors hedge against this kind of event, or should they even?
Well, right. That's a great question, because these kinds of risks, in this case, several of them are significant enough that you can hedge. Like, for example, with the oil price and the Iranian issue, if we do start to see the U.S. take action, then it would be a buy signal for the oil price. But in other cases, do you want to be the one that goes out there and withdraws from this bull market rally? It's hard to do that. It might be better to sort of be neutral on equities, given that we've had a lot of good news, but that some of these risks may not develop. Nevertheless, one important hedge, gold, has already skyrocketed so much that you have to think, well, if several of these issues actually transpire, like conflict between EU and NATO or conflict between China and Taiwan, then in fact, U.S. Treasuries would be pretty attractive.
All right, Matt, got to leave it there, sir. Thank you for joining us. Matt's Chief Geopolitical and U.S. Political Strategist, BCA Research. Canada's Arctic makes up 40% of its total landmass, but just 0.5% of the GDP. It is, of course, filled with rich minerals. The production of them is lagging compared to adversaries who are interested in that part of the world. CTV's Heather Wright has more on this.
Come on. Come on, guys.
There are few things more quintessentially Arctic than being pulled by a sled dog across a frozen lake.
In the wintertime, we offer kick sled tours pulled by huskies. Good boy, bud. Good boy.
Richard McIntosh is the co-owner of Sundog Adventures and says tourism in the north continues to grow.
Rum, come on, Rum.
Attracting not only visitors, but also employing thousands of people.
We hire guides every year, and we hire service staff every year. But without the tourism, we wouldn't be able to employ nearly as many people.
Canada's Arctic makes up 40% of its total landmass, but just 0.5% of its GDP, according to government figures. Mining continues to be the main industry in the Arctic, but insiders say the full potential of resources here remains untapped.
There's 2 gold mines in proximity.
Karen Costello is the executive director of the Chamber of Mines and says more government investment is needed in the north, not only to attract private investment, but to beef up security as well.
You can't get more present than that. When mining is here, mining employs northerners. It works with Indigenous businesses, Indigenous development corps.
Canada's Arctic economy is quickly changing. Warming seas and increasing global demand for critical minerals and natural gas have intensified competition in this region.
Everybody is in this infrastructure race.
Brendan Bell is the CEO of West Kitikmeot Resources, an Inuit-owned company spearheading the development of the deep water port and extensive road network known as the Economic and Security Corridor. It's a massive project with a number of environmental concerns, but if completed, it would connect Nunavut with Canada's highway system in the Northwest Territories.
Canada has lagged significantly behind both our adversaries and our allies who are interested in this part of the world. So I think we're left with very, very few options here, but to make some significant investments.
While Canada has some of the largest reserves of critical minerals, which are used in everything from smartphones to cars, it lags significantly behind countries like China in the ability to process them. It's another area experts say is in need of investment.
CTV's Heather Wright reporting. Next is Hot Picks. We zero in on biotech, including a company working on treatments for autoimmune diseases. Back in a moment. Today on Hot Picks, we were joined by David Niergarten. He's a senior analyst at Wedbush, and he took a dive into the biotech market. We kick things off with Spire Therapeutics as his top pick. He says the company's working on treatments for autoimmune diseases.
By multiple genes and multiple environmental factors. One of the common autoimmune diseases is multiple sclerosis. Spire is working on several others, including ulcerative colitis, Crohn's disease, and rheumatoid arthritis and other related rheumatoid diseases. So there are, psoriatic arthritis is an example of that also.
And they have some possible catalysts coming up, 3 data events in Q2. Can you tell us about one or two of those?
That's right. So they have 6 for 26, as we're calling it. They have 3 actual data releases for their monotherapy studies, phase 2 in ulcerative colitis, 3 different drug candidates, but they're targeting known targets in ulcerative colitis. So we think it's a high possibility of success for those studies. Importantly, those studies should show that the drugs can be dosed once every 3 to 6 months, making it a lot more convenient than the current therapies out there for patients with this disease. And in the second half of the year, we'll see additional data for those other rheumatology diseases, such as rheumatoid arthritis and psoriatic arthritis that I mentioned earlier.
Apparently, this whole autoimmune area is being shaken up by this microchimerism, whereby the body has cells from other people in it, and maybe they're part of the problem. I know it's very early days.
That is a theory that's been posited as a cause for autoimmune diseases for quite some time, particularly in women. When they're pregnant, women, do have cells from a new person, of course, in utero, and there tends to be in a lot of autoimmune diseases higher rates of those diseases in women, particularly women of childbearing and post-childbearing age, early, post-childbearing age. So in their mid-30s to mid-50s is a frequent increase in incidence for those diseases, again, in those women.
You have another idea for us. Disc Medicine, the symbol is iron on the NASDAQ. What are they working on?
So they're working on rare diseases of the blood system. So they have a product candidate that's in review right now with the FDA, bitopertin, for a rare disease called EPP. It causes a buildup of a metabolite that reacts with the sun to cause pain, actually a significant pain in patients in their skin, and can cause liver problems also. That's under review right now. And then they have a couple other drug candidates for either iron deficiency causing anemia or iron overload causing too high levels of iron in the blood in other rare diseases and related diseases of myelofibrosis and other disorders of the blood system.
And then finally, Kiniksa Pharma, it's working on recurrent pericarditis, pericarditis. I'm very sorry. What is that ailment, please?
It's a very painful inflammation of the heart. So a patient will have an inflammation of this, there's a pericardium, it's a sac surrounding the heart. And that inflammation, as you can imagine, can cause severe pain. Patient might feel like they're having a heart attack, frequent trips to the emergency room with severe pain. And Kiniksa has a drug called Arcalyst that treats it very well. It reduces recurrences by 90+%. Patients are on the drug for quite some time typically, and that's really driven sales here. We estimate 900 million plus in sales in 26. And the company is a rare mid-cap or small-cap biotech that's profitable. They will have a positive EPS, and what is really going to trigger upside, in my opinion, for the shares will be their less frequently dosed, wholly owned asset, where we'll see some data for that in the second half of the year. That could literally double their profits if it were successful and approved eventually.
Because right now, I think you mentioned they're in a partnership with Regeneron, which stands to get some of the earnings from that drug you mentioned.
Correct. Regeneron gets approximately half of the profits. There's some adjustments for expenses here and there, but it's roughly half of the profits. And so obviously they have a wholly owned replacement, hopefully with positive data in the second half of the year that could lead to a drug approved with literally double the profit margin.
And there could be then acquisition in the cards if that all works out?
I would expect that. This is a very, again, it's a profitable franchise. It's well contained, meaning, you have a relatively limited sales force that can, go out there, sell the drug, limited, additional infrastructure required. It would be a great bolt-on acquisition for a mid or larger size pharma.
I've got to ask you, when you look at DNA and the evolution, do you find yourself learning new things all the time? It's pretty amazing.
There are a lot of new things out there. The most exciting thing for me is really when we do see some of these new mechanisms get developed. I've been doing this long enough where I've seen some, targets that were, mere ideas, 10 years ago, and now they're, getting into the late stages of approval or are already approved drugs, and it's really gratifying to see that.
That's pretty amazing. Whenever I read something, it looks like they're finding DNA is more complex in its mechanisms than they thought before.
There's a lot of complexities, autoimmune in particular. Some of the mechanisms for causing those diseases that we just talked about are very complex. I don't think there's a single target, for example, for ulcerative colitis that will be the cure-all for everyone. I think we're going to need combination studies and combination therapies for that. But it's there's a lot of complexities in those diseases. Maybe we will find a single target that really leads to a much better drug candidate and approval.
David Nierengarten is a senior analyst at Wedbush. All right. Quick look at how we ended the day on Bay Street and Wall Street. The TSX dropping 51 points today, so going to 33,093 after that record high at the end of last week. Moving to the U.S., where the markets ended up above ground today in the green. The S&P 500 had a 34-point move up, 0.5%. Dow Jones 313, and the Nasdaq a 100-point move up, 0.4%. Okay, let's tell you about what is coming up tomorrow, because we have Know Your Options coming back. That is tomorrow at 3 p.m. Eastern Time. So you can have all of your options trading questions answered by Chris Tom of Moat Financial. Send us your questions and Know Your Options at BNN Bloomberg.ca. And again, 3 p.m. Eastern Time on Wednesday. That does it for the close. Thanks for joining us. We'll see you tomorrow.